And I can promise to you that it's really improvised. Bravo, Camille. Messages better transferred, communicated through music. So in the following, in the next stage, the next step of the previous roundtable. Well, now let's listen to Jean-Christophe Caffet, the chief economist at Coface. He's going to tell us about the economic outlook. Thank you, Camille. I've just, it's a dream of when I was a kid, going on stage, coming on stage with a music of Star Wars as a background. So, Jean-Christophe, say it must not be easy to do your job, namely to do forecasting these days, right? It's not easy indeed. It's even less easy in the existing context. Okay, so we're going to talk about forecasts anyway. That's also what we're here for. So let's talk about your 2026 outlook. Last year, you said stabilization of the economy at 2.7%. Indeed, there was a stabilization of the global economy, 2.7%. Or even stabilization at 2.8%, and congratulations to all of you. Because the 2024 figures were revised upwards by 0.1 percentage points. Because we scored a strike, if you'll excuse the expression, with accurate forecasts for all the major countries, from the United States to Japan, including, of course, Europe, and most of the major emerging markets, such as Brazil, Turkey, and so on. The only real surprise was India. It continued to accelerate with a growth of over 7% last year, though we expected a slowdown. So we're not going to come back to the figures in 2025, but only the US grew by 2.2%, the UK by 1.4%, precisely what was predicted a year ago. Well done, Marcus and Jonathan. Leaving Ireland aside, we saw a modest 1% growth in the Eurozone, with Germany still struggling, plus 0.2%. And Spain continuing to outperform. We should be close to 3% of growth. What about China? 5%, obviously. That was the CCP's target, or 2.5%, depending on, Well, 2025 was marked by uncertainties. You said that there would be a risk of recession, inflation, short stagflation, with a growth exceeding 2% and inflation between 2.5% and 3%, but the numbers don't quite add up. Indeed, the risk was very real last spring, given the measures taken by Donald Trump, by Trump's administration, at a breakneck speed in the first months of his presidency. We remember Liberation Day on the 2nd of April, with the announcement of tariffs of up to 140% on China. So this didn't happen for several reasons. The first of these reasons is summed up in 4 letters: TACO, TACO, Trump always chickens out, or Trump always backs down. And indeed, because after culminating at 36%, based on my calculation for the countries, the average tariffs were reduced to an average of 17%. And today, the observed rate on the ground is only 10–12% due to a number of exemptions, optimization, or circumvention strategies employed by companies. So to put it clearly, the price shock in reality was 3 times less powerful than announced. Second reason is that comes to my mind is that the reduction of tax with the Beautiful Bill Act. At the beginning of the summer, they've obviously helped to support American domestic demand. It's particularly true for spending by the wealthiest households, the main beneficiary of the tax measures, with a figure that speaks volumes about the evolution of inequality in the United States. The wealthiest 10% now account for 50% of consumption. And also those companies who've borne the shock when using, based on their profit margins. That it's clear here. The results of our research are quite clear on this point, because indeed the households have absorbed the tariff shocks. 90% is borne by Americans, households or companies. Only Trump's would, deal with these tariffs.
Well, it didn't happen because everything was borne by the margins, and also something else. There was a lot of significant investments in AI, astronomical. That's actually the third reason. Yes, when we talked about frenetic investments in AI and all related infrastructures and facilities, that was actually an important driver for demand. There were also high-income household spending because there was wealth induced by the stock exchange valuation and high-tech especially. When we say that, do we have to understand that the tariffs bill or the missteps of the economic policy will come late this year, namely 2026 prospects? Will they be worse than 2025? Maybe, but not necessarily. If you want, there are powerful supports of winds, of tailwinds that have been blown on the macroeconomic environment. Energy, for instance, that is quite reasonable, if not weak. The depreciation of the dollar, 10% also. That also supports the global macroeconomic environment. And then we also have a policy mix, budget and monetary policies that are quite accommodative also. So if we exclude China, it's a big chunk, of course, but we would see global growth stabilizing around the same level as last year, roughly 2.8%. If we include China, where we forecast a significant slowdown between 4 and 4.5%, we would lose close to 0.2 of a percentage point. So it could be more if we follow what Agatha is saying, but since they report 5% anyway, that's excluding China. For the rest of Asia, we expect a slowdown. We expect 6%. That's twice the global growth. China remains a driver, undoubtedly. As for ASEAN, this would also slow down 4.5% if we take the US. For the US, yes, to use the expression, yes, households would eventually feel the bill, given the incomplete pass-through of tariff increases to consumer prices. But as we said earlier, 2026 is an election year. It's the midterms, so it's highly uncertain. So I think that we can assume that Trump will do whatever he can to resolve or attempt to resolve the current affordability crisis. It has already started with measures which are useless, such as caps on credit card interest rates and mortgage rates. It won't be sufficient, I don't think. I don't think it will be sufficient as it is today, economically or politically, especially if fuel prices at the pump remain well above $2 per gallon. But as for now, this is what we ask for Europe. It is complicated to take a firm view given the high level of uncertainty, not only in France but also in Germany, because the implementation of fiscal commitments will be decisive for Germany but also for Europe at large. We talk about 1%. This is what they announced, but 1% is what we also expect for France. Because we have a budget which is not too restrictive, because we have 5% deficit, and we should have 1% in Europe, in the Eurozone overall. So when we talk about growth and commodity prices, does it mean that the conditions are not met to have lower energy prices? Because you said that they ought to increase them. I could spend hours on energy, but if we look at oil, it's quite well supplied. We have an excess of 2 million barrels per day this year as we stand. So I think that the prices will go downward even more. If not for the geopolitical premium, which is linked to the current context. For natural gas, it's roughly the same. We are well supplied. We have new liquefaction capacity coming online, especially in North America and Qatar. That's 4 million tons we're talking about, so not a lot of concerns. For energy, if we exclude the geopolitical shock that involve a major hydrocarbon producer, there's little concern. Obviously, if Iranian production were to exit the market, we're talking about 3.5 million, or the Strait of Hormuz were durably blocked. If the Strait of Uri as well, then the situation would change radically. As for agricultural commodities, not a lot of concerns because the prices are 20% below pre-Ukrainian crisis. As for metals, we have a lot of inflation, especially for ferrous metals. But metals and their impact on the consumer prices is quite, because we don't buy a lot of copper coils or steel beams, of course. So as to monetary policy, we're talking about easing, apart from the Bank of Japan that raises rates. Do you think that this easing will continue? I'm talking about the Fed. All the more that Trump is claiming for rates being cut down. Well, in 2025, over the past 18 months, we've talked about it with Bruno and Ruben, we've had 60 rate cuts from major developed central banks for a total of around 1,800 basis points. That's half of what we observed during the GFC. Between June 2008 and December 2009, there was no financial crisis since then. The activity is holding up, and the inflation is still above target with these central banks in many monetary areas. So what I want to say is that monetary policy was into cycles and has been a powerful support to activity and to financial markets. So we're reaching the end of this easing cycle. Except if we have a disaster, 2% is probably the terminal deposit rate for ECB. We can have Bank of England or the Fed, where there might be a few cuts left. But given the inflation, it should remain above target. But when we look at the current situation, the Fed, where we have an inflation above target and a labor market that is softening. We've seen the last figures in January that were above the consensus. But anyway, the Fed has always chosen to, over the past 30, 40 years, to support employment, so to cut rates. It would be surprising if it were not the case today, despite the pressures that it is facing. Powell has resisted Donald Trump's pressure so far, but his term of office will end soon, and he will be replaced by Kevin Warsh, as appointed by Donald Trump. Are you concerned about a loss of the Fed independence? Yes, I'm concerned, even though I was never completely convinced that the Fed was completely independent, so to say. There's always been what we say in our jargon, fiscal dominance, mainly subordination or at least dependence of monetary policy on fiscal policy for the sake of financial stability. That's what the central banks do as well. But at least that independence was statutory, which prevented complete monetary chaos, to put it bluntly, namely primary financing of the fiscal deficit. In other words, it's pure money printing, so to say. We have seen recently in some countries. But what about some markets? Do you feel that there's a concern on the independence of the Fed that would actually entail the dollar's decline? It's not only the dollar, actually. A lot of other currencies, not the Swiss francs, which is maybe the debasement rate. I won't go back to that, but given the current situation at the global level, we have a level of accumulated debt which reaches 100% of GDP for public debt alone. So that is important. If you look at American market, the dollar has lost 10% in effective terms against all other currencies since Trump became president. So in a context of relative US outperformance and more restrictive interest rates with higher interest rates, this is not insignificant. We can talk about the war of exchange rates, but if we have the depreciation of the dollar and depreciation of the renminbi on the other side, that could have an impact on the competitiveness of Europe. We had the Draghi report recently, and they talked about the competitiveness compass of the European Commission, but it doesn't seem that we've moved forward that far on that front. As for short term, for competitiveness, what is important is the evolution of exchange rate developments and the trade war and tariffs. On the first point, it's, of course, the depreciation of the euro's main competitor currencies, and I prefer to speak of depreciation of those currencies rather than depreciation of the euro, because I would struggle to identify strong fundamentals justifying euro strength, but these depressions are clearly hurting. As for the US tariffs, contrary to much that has been said or written, the EU has not fared too badly so far for a few reasons. First, because it preserved its integrity in negotiations with the US administration. And it was not a state-by-state negotiation. And second, because 15% tariffs are that they have, the EU, it is broadly in line with or even slightly below the average tariffs applied to our competitors. So there's no loss of relative competitiveness to the rest of the world in excess to the US market. And bearing in mind the stance of the US administration towards the EU, this was not a given. And then, to go back to the competitiveness compass, what we feared has unfortunately happened. That means that was actually an extremely slow and laborious implementation, because we stand at 10-12% completion of the Draghi report. And actually, it was postponed by more than 18 months. But the main merit of that Draghi report was to underline the emergency of the situation, to try to have an imperative, swift, decisive action, because they were talking about the fact that we were heading toward a slow agony. A lot of programs and plans were launched. Yes, at first. Hey, you're trying to pull my leg, Stefan. But anyway. Priority was given not to the certification, but to deregulation, and especially to unwinding everything that was done with the environment, like the Green Deal. And it's a pity, I have to say. We have to understand each other. I don't love rules. I don't like norms and laws for the sake of laws only, but I'm not certain that this will answer and meet with the objectives of the EU. Simplification, deregulation are not one of a kind, are not the same and only thing. We can simplify, we can give a rule, we can enact a rule and set a rule in a crystal clear manner that will be applicable everywhere, that is easy to understand without complicating the situation. But the Draghi report was not only that. No, Draghi report, well, I'm not going to dwell on that, but it was not only that. There's a lot on the Industrial Act, the Industrial Accelerator Act, if my recollection is correct. But what prevails today is rather that the European Commission has decided to go backwards on the Green Deal. And that doesn't meet with the triple objective, as Thomas reminded us of, to face the strategic autonomy, the competitiveness, and the energy transition objective. These are actually not contradictory. And I looked at the Echo, and you said that the bursting of AI was one of the main risks for the global economy. So two pieces of information. There's a bubble, and it may burst. I don't know whether there's a burst, but it is highly possible that it could burst. Well, more seriously, joking aside, there are clearly excesses in valuation levels for some companies, particularly those generating no profits. There are also doubts as to the colossal investments. We talk about $660 billion this year at last count, which shows actually why there were actually adjustments. There's also risks linked to the high degree of interconnectedness within the sector. We've seen it in the newspapers. We've seen NVIDIA taking a 100 billion stake in OpenAI, which in turn commits to purchasing 100 billion worth of NVIDIA chips. I don't want to dwell too long on a subject that has already been thoroughly examined by the profession, including by ourselves. But what I want to say is that I think that the market will consolidate. What does it mean in plain terms? Well, some companies will fall by the wayside, or they will be redeemed. It's difficult to say precisely when, because many questions remain unanswered. Technological progress, which is indeed rapid, the firm's ability to monetize this development, and the speed at which AI will be deployed and rolled out by the companies to deal with that. So there's a lot of uncertainty, but there will be casualties, especially notably because of network effects. With the high tech, we actually invest everywhere. We explore multiple avenues. Not all of them will prove profitable. And in the end, well, the winner takes it all. The winner takes it all. There might not be only one winner, but certainly there won't be dozens of them. And so there will be goodwill write-downs, as after the dot-com crisis in 2000 last year. You talked about the neither nor. You said that you were neither AI skeptical nor AI evangelical. Has this stance, this opinion changed? And this is a joke. Well, things are moving fast, especially when it comes to AI. So to go back to this expression, which is actually mine, I would say that I remain convinced, but I'm much more concerned. I'm neither skeptical nor blindly enthusiastic. So, you're very worried about jobs, are you? Recent studies suggest that over the last years, AI had not destroyed jobs so far. I'm going to quote Philippe Aghion, the Nobel Prize for Economy, who said that the firms adopting AI actually created jobs. Oh, well, these are compelling arguments, aren't they? Well, those studies, at least the first ones you mentioned, I read them. They do not prove very much, in my opinion. They provide a static snapshot, valid at time t, but they say nothing about future dynamics when we talk about coders, about developers, but these results don't say much about what will happen about the future. It's not because AI hasn't destroyed jobs that it will not do so over the next years, given the expected technological progress. This is actually the purpose of the research that we are conducting, and some results will be presented after the break. As for Algen's work, for which I have the utmost respect, well, I think that the conclusions have sometimes been interpreted too hastily. His analysis is conducted at the firm level, micro level, very micro level. Firms that adopt AI, well, they go through competitiveness gains, and so they increase market share. This is what they want to do. And so typically, we have a microeconomic result that cannot be automatically extrapolated to the macroeconomic level, because not everyone can gain market shares. So we need to increase the pie, basically, the size of the pie, yes. For that result to hold at the macro level, the effective demand, the aggregate demand, must increase. And that requires for productivity to be broadly shared, so that there's no, that the distribution of value added does not become excessively skewed, and that, in plain terms, gains must not be captured solely by a handful of actors, whether those developing AI or those deploying it. And this is far from being guaranteed. First, because AI is clearly a substitute for labor in many sectors and occupations, and for a lot of jobs, especially jobs that are highly qualified and well paid. And that's across all scenarios. You'll see that after the break with Axel and Aurélia. So if you want, the risk is that there's an increase in lower skilled jobs. And so that the share of the lower paid employment in total employment will decrease, unless lower skilled jobs are significantly upgraded, but I doubt this. So AI is not a substitute, but rather a complement to labor. Even if it becomes, nothing guarantees that the productivity gains generated will be redistributed to employees. Very concretely, I have not yet heard a company say that it is deploying AI to create jobs or increase wages. Maybe it will happen, but even if it were the case, there's nothing shocking as a microeconomist as I am, to think that the capital share of income would increase if the capital intensity rises. And this is even more likely, and I insist that it could happen only if the labor market balances are profoundly altered, with a decline in workers' bargaining power due to the job destruction that I mentioned earlier. I would like to insist on something when we talk about the progress of robotics. This will not improve things. AI and robotics individually have caused a lot of damage. If we combine them together, I can imagine what it will create in terms of inequality and social imbalances, and we'll give you figures after the break on AI. Economists love figures, and they also like letters, and especially when they want to describe curves. There's all the letters of the alphabet, especially the K letter, which is to describe the growing imbalances, the richer getting richer and the poorer getting poorer. We talk about the K-shaped economy that comes from the US, but we've talked about it in France with the Zuckman tax.
I promised you a very personal interpretation of that. Well, Zuckman tax, we have 3 minutes, 4 minutes left. Are you in favor or against the Zuckman tax? Against, contre, namely against, for and against. No, joke aside, everything's been said and repeated about the Zuckman tax, so I'm not going to add fuel to the fire. Every person who lived in France, who was in France over the last 6 months, experienced that. But it's not because the proposed remedy, which is a minimum of 2% wealth tax, it's certainly not the solution. But that doesn't mean that we should ignore the diagnosis of wide inequality. This is a diagnosis which is not new. The IMF dedicated chapters about that, about the subject. Many articles of the Financial Times as well, also a cover of the Economist last year, where there's a golden pacifier titled The New Era of Heritocracy. So you see, this is a diagnosis that is not only that of an activist NGO. Well, as for the genesis of inequality, there are many factors for that, you know, labor market polarization, monetary policies, and so on, so forth. But in the developed countries, this is the result of very, very high incomes and very, very high wealths as well. And UBS Bank has confirms this. Yes, they can't be qualified as being Trotskyists. So, this is a widening of inequalities in both their components, in Commonwealth, which generates very strong resentment, particularly among the middle and upper middle classes who've seen their very high incomes skyrocketing, while at the same time the lowest incomes have seen a significant increase. This is one of the consequences of the inflationary crisis of the last 3 years, with the indexing or near-indexing of low wages and social welfare benefits to inflation. And if you add to it a pressure to the public finances with the decrease in tax increases or tax policies that are very aggressive, such as the beautiful Bill Act, you know, it consists in lower taxes for the wealthiest, but also higher custom tariffs, custom duties. It's like in France, an anti-social VAT. So if you want that increasing pressures on public finance, you know, it's you understand why our social and political risk indicators are where they are. Yet that's not really what we see in France. We have a very redistributive tax system and we don't cut spending. Otherwise, we'd know about it. And yet the debate has been and remains very heated. How would you explain that? Yes, you're very right. France is one of the countries that redistributes the most in the world. INSEE work carried out in 2023 showed that the income gap per consumption unit to neutralize the size of households between wealthy and poor households, in other words, the 10%, the first and last decile of the population, well, it went from a factor of 18 before redistribution to a factor of 3 after redistribution. However, there's a feeling of inequality which is bigger than elsewhere. Well, if you compare that to what's taking place at an international level, if you look at, if you compare relative poverty rates, the proportion of the population living on less than 50% of the median income, before and after redistribution, well, you will see that the gap is 28 points. This is the highest figure in the OECD, along with Finland. So I don't have a specific explanation as for how heating the debate is in France, heater than elsewhere, except perhaps that the distribution isn't enough, that we all prefer to live off the income we earn rather than on transfer payments, or that the French are fundamentally committed to equality. Or is this just our grumpy, complaining side, you know, as French people? Is that your final word? Yes, well, no. I'd like to end to a more positive note, or rather on something more balanced than what we often hear in an increasingly hysterical public debate. To paraphrase a well-known writer, France may not be a paradise, neither socially or fiscally, obviously, but it's perhaps not the capitalist or confiscatory hell in which some, or at both ends of the spectrum, believe they live. Well, thank you very much, Jean-Christophe Caffet.